Hello, everyone. Welcome back to another episode of Signal or Noise. It's episode 67. Charlie Bilello here, and with me, as always, my co-host, Peter Mallouk. Peter, just one topic for today. This is going to be a timeless episode for people to come back to. It's going to be relevant each and every year because there's always volatility. There's always corrections in markets. And so I'm calling this the ultimate guide to volatility and correction. So let's begin with there's always something. Peter, this is a list of corrections since the March 2009 low, 31 of them, 5% or more in the S&P 500. And most of these, Peter, people have completely forgotten.
Yeah, these happen all of the time. When we know there's a drop every single year of 10% or more, average drops 14%. So these drops of over 5%, they're so incredibly frequent. But what has been strange or unique of late is, the last couple of years, with the exception of that tariff war, it's been pretty rare to have these pullbacks. And so I think this is more of a return to the norm. We just cannot have year after year of straight up and to the right. We're going to see more activity, especially as it seems the Trump administration tackles thing after thing after thing after thing that have conflict associated with it. And so it's one thing at the beginning, all these agendas were more social. A lot of the policies have economic and military implications, Venezuela or the Middle East or Greenland or Ukraine. We're talking about Colombia. And then you've got all the economic battles that are happening at the same time. I think we're going to see a return to some very healthy volatility.
So let's talk about that volatility, what to expect. Investors have to expect volatility, Peter, but often the question is, well, how much is this normal? What should I expect? So we're going to run through all of the historical data here, starting with this chart here, which would probably surprise a lot of people that every single year there's a drawdown, Peter, an average since 1980, and this has been a great period for the stock market. U.S. stocks up 12% per year over this period of time. The average drawdown during this period is 14%. You go back to 1928, it's actually higher, 16%. When an investor looks at this chart, what should their takeaway be for this year?
I think that the takeaway would be I would expect that you're going to see a drop in the market at some point over the year of almost 6,000 points, because that would be completely, totally normal. And the expectations over the long run, you get rewarded for it. And you just kind of go in embracing it, not worrying about it at all, but just embracing the reality of it, and know that as a stock market investor, this is why you get the extra returns. If the market had no volatility, more people would be in it. The expected return would be lower.
Right. In the last 3 years, 26% return for the S&P, 25% return, 18% last year. That did not come without risk. You had a 10% drawdown in 2024, max drawdown 8% in 2025. 2023, you had 10% max drawdown, 8% in 2024, and last year 19%. And that did not prevent these huge 3-year gains for the S&P 500. But in terms of this year, Peter, the question will be, well, how's it going to be this year? We know it's going to be something. Every year has a drawdown of some amount, but pretty much every other year, I think you often talk about this, you get a 10% drawdown in the S&P 500. And if you go out to 20%, it's really every 4 years on average.
Yeah, it's incredible frequency, and those bear markets, and all of these things don't spread themselves out nicely, right? So sometimes you get two corrections in 1 year, two bear markets back to back. It's a box of chocolates every year, but over the long run, how it's gonna turn out.
So let's talk about big declines, because this is the headline inducing declines. And yesterday we had one of them, it was 2%, and that feels like a lot, feels extreme. And you're going to have many more of these in 2026. It's going to be a different headline probably every single time. What I was talking about yesterday in terms of the 2% correction is I went back and looked, well, what was the biggest correction before that? It was back last October. And you probably forgot the reason, but it was actually another tariff threat against China. And then within 2 weeks, the market was back at all-time highs. So oftentimes, Peter, very quickly, you forget the reasons for these big declines. But if you didn't have these 1%, 2%, 3% down days, you wouldn't get those bigger returns from stocks. You obviously don't have this type of volatility in bonds or cash, and that's why stocks are giving you that higher return.
That's exactly right. Like the good investor, buys and holds, kind of bites their lips, strengthens their abs, and waits through it. But the great investor looks at this as opportunity. I mean, it's we know it's going to come, and how do I take advantage of it?
So let's talk about those bear markets. You alluded to this, and we've had quite a frequent amount of them in the last 7 years. So since 2018, really, we've had four different bear markets. None of them lasted extremely long. The longest one was in 2022. It took a little while to claw back out of that, but bear markets are going to happen. So let's say someone, Peter, they're 50 years old. They're well into their tenure as an investor. What should they be expecting over the next 30 years in terms of bear markets?
I mean, over the next 30 years, you're going to get, you know, 6, 7 of these bear markets. I mean, over and over and over again. Each one, like a horror movie, it'll come with a different screenplay. Same outcome, right? It'll go away, and then you look in the corner of the closet, and the doll's lights, turn on because it'll be back for a sequel. It's just going to come back over and over again. Just embrace it.
And every bear market's different. So 20% bear market, you see every 4 years on average, 25% 7 years, 30% 9 years, and 50% decline, 20 years on average. Of course, they're not spaced out evenly. It could happen at any point. And I think an important point for investors to remember is not every bear market has an economic reason associated with it. If you look at this chart over here, you'll see the one we had last year, the one we had in 2022, there was no recession in the US. So the stock market and the economy, long term, they're correlated, but in the short run, you could see big deviations. And in terms of down years, Peter, we haven't had one in a few years, but 3 straight up years. Shouldn't an investor pretty much always be prepared for a down year to happen in the stock market?
Yeah, I mean, 1 out of 4 years is negative, and if you've been a client of creative planning for the last 8 years or 20 years, that's almost exactly what you have experienced. Is 3 years up, 1 year down, and the average return is never what you expect it to be. It's always greatly exceeds or falls behind what a normal return would be. There's wide dispersion of positive and negative, and wide dispersion in how positive and how negative.
Yeah, as I like to say, looking at this chart, without the left side, without the red, without the down years, you don't have the right side. And stocks don't move up in a straight line. We know that it may seem that way because we've had 3 straight positive years. But as we just talked about, a lot of volatility in between. And there's always that chance of a down year or a longer bear market. And that's the risk premium, Peter, that is really illustrated here. So, really, there's only one reason investor should try to withstand that higher volatility, the risk of drawdown, the risk of being in the market during a recession or a bear market. And it's this chart right here, because that higher risk gives you that higher return than if you were in the bond market or in cash. That higher return, it may not happen in the short run, but in the long run, looking at rolling 10 years, 20 years, 30 years, you tend to be in a much better position in terms of building wealth by being invested in stocks, being an owner, as you say, versus being a lender.
Yeah, that's right. Over the long run, you want to make money. History is very, very clear. Be an owner over a lender. Owner stocks, lender bonds.
So let's talk about how to react, because people don't like to just sit there. They want to do something. And the biggest thing that we would counsel people during times of volatility, during times of fear, during these nasty headline periods is don't panic. And looking at this chart here of the last four bear markets and investor flows, Peter, we know for a lot of people, not creative planning clients, but for a lot of people, this is a situation that really hurts them because they're panicking at the exact worst time during these bear markets. So selling after the decline.
Yeah, I mean, it is incredible, and it's very sad because these are real people with real dreams that are tied to money. Being financially independent, paying for a kid's college, retirement, all of those things. And over again, 2018, 2020, 2022, 2025, we see peak selling at the bottom. So people truly capitulating and converting to cash at the worst possible moment, absorbing the loss, not participating in the gain. This is the number one way to screw up your investment plan. And in the very first book I wrote, the very first paragraph of the very first chapter, is to not make this mistake.
Yeah, I think you said volatility doesn't equal a loss unless you sell. It's just a short term thing. And really, the risk is, Peter, not just the selling, but it's the not getting back in. And I often illustrate this chart, but I just updated it through the end of last year. If you look at the last 10 years, it's been great for the US stock market, annualizing at close to 15% per year, almost up 300%. But had you sold like many did at the March 2020 lows and didn't get back in, your return over that period of time less than 2% per year. So Munger's quote here really rings true. The first rule of compounding is to never interrupt it unnecessarily. Let's talk about staying diversified during corrections, during downturns, during bear markets. Again, we're only 3% off the highs for the S&P 500, so not huge. But I think it's pretty interesting, Peter, this year so far that we're seeing a repeat of what we saw last year during the tariff turmoil. But even more so, we're seeing an outperformance of small caps over large caps, which we talked about on the last episode. Hasn't happened in a long time. Mid caps outperforming, international stocks continuing to lead. So we talked about last year was their best outperformance since 1993. Emerging market stocks, international developed, outperforming, and we're seeing value, Peter, outperform growth. And meanwhile, you have the S&P down slightly on the year, large cap growth stocks down, and the Magnificent Seven trailing everything else. What do you make of this?
I think this is one inning of not even one inning of this year's baseball game, right? It's way too early to read into any of this. We do, though, see a history of the calendar year being associated with what's in favor and out of favor, whether it's the US versus international or large cap versus small cap. So sometimes it has legs, but very early.
Yeah. And as we said in the last video, it wouldn't be shocking or surprising given the outperformance that we've seen to see a reversal. We saw with international small caps, equal weight, value have been lagging for a decade plus. Could this be it? It could be. But no one's going to ring a bell and tell you. You only know it after the fact. That's why you have to be diversified in advance. And in terms of the decline, Peter, the better way to frame it is to look at it in terms of opportunities. We're always doing this at Creative Planning in terms of tax loss harvesting, looking to rebalance. And again, it's not a big enough decline where we would consider doing that. But you want to be aware of that. You want to be ready to do it, thinking about investing idle cash that you're not going to need for the next 20 years if a big decline were to happen.
Yeah, I mean, the bear markets or corrections really present big, big opportunities to get better after tax rate of returns, to rebalance from bonds over to stocks, which is forced selling high and purchasing low. If you've had money on the sidelines, gives you an opportunity to deploy. I mean, really, and if you're young, you're contributing to a retirement plan. I mean, even if you're 60, you're contributing to a retirement plan. The bear market or a correction is a gift, an incredible gift, because you're able to just keep buying.
Yeah, I have this post that you put on X last April. I think it was the day of the low, I believe. But if you're young, congratulations, you've been given a gift. And just encouraging people, keep investing, keep doing your saving in your 401k or IRA. And if you're near retirement, you're at retirement, well, you should have that reflected in your portfolio. You should have enough in bonds to sleep at night and get you through long corrections. That's what you're saying here. And essentially, you wrote last April, the odds are overwhelming that stocks will be at new highs before you need to access the money. And that, of course, happened last year. Obviously, every time is different, but enjoy your day. I love this. And ignore the markets and embrace the chaos. The exact reason stocks provide better returns over the long run. This is it.
Yeah. And this was in the middle of like the tariff war. Obviously, that worked out really quickly for people that stuck with it. It could have taken a lot longer, but that advice holds true. If you're contributing, it's always a gift to have a bear market. If you're not contributing, you're in the spending years. It's why you have bonds. Either way, sleep well.
And in terms of the drawdown, I have to always show this because a lot of people think that just because something is down, it's likely to go down more. Not the case in the stock market. The average forward returns when the market's in a drawdown are very positive over all time periods. And if you go out 15 to 20 years, the bigger the drawdown, the bigger the future return. And that should make sense to people because you're buying stocks when they're on sale. And this too shall pass, Peter. as we talked about with that list of corrections since March 2009, and this is going back to 1989 here, many of these reasons seemed like an absolute crisis that we would never recover from in the past. There will be more of these. So this chart will be updated with something maybe this year. If not this year, then likely the year after. There's going to be something. It may not be the situation with Greenland. There's going to be something in 2026, and you have to believe as a long-term investor that that's not going to be lasting.
Right. The headlines in retrospect, we get so caught up on them. And then you look at them 10 years later, you just kind of shrug your shoulders, right? About how worked up we get politically about things day to day or economically, how much we get absorbed into the chaos. But, you look historically, they're all blips on a path. And it's kind of like a case for stoicism. The highs don't need to be that high. The lows don't need to be that low. The world's going to keep spinning. Don't get too caught up in the moment.
Yeah, and if you stick with it, look at that reward. $1 grows to $41 over this period of time. Just tremendous growth. And every bear market is followed by a bull market. And the good news for investors is bull markets last far longer and are far bigger than the declines in bear markets. This is why you're getting that around 10% return in the long run. 5 years on average for the bulls, 1 year on average for the bear. Of course, every single bull market and bear market are different in terms of that. But should be comforting for investors that the standard over the long run is the good times last much better than the bad times. And I'll end with this chart right here, Peter, that you often like to talk about. In the short run, a lot of things can matter: interest rates, tariffs, all the negative news of the day. But in the long run, there's really only one thing that matters, and it's why you should believe that every correction or every bear market, every recession is eventually going to be followed by an expansion and new highs in the stock market.
Yeah, the stock market ultimately is going to follow earnings. So the stock price today is always a reflection of future earnings and nothing else. And in the long run, it will match up with earnings and nothing else.
So if you believe 10 years, 20 years, 30 years from now, earnings will be higher than today, you should be optimistic that we'll get through any correction or bear market that arises. I think that's a great place to end. Thank you, everyone, for joining us on Signal or Noise. If you're watching this on YouTube, hit that subscribe button. We're also available on Apple and Spotify. Peter and I will see you next time on Signal or Noise.